All right, so the last couple of days, first of all, we've been trading a couple of iron condors, and primarily we did so because we know from our seed iron condor training that we can make adjustments on them, and if we capture the adjustment at just the right time, we can end up with a positive credit on the remaining iron condor. So we take a profit, we end up with a positive credit. You don't want to make adjustments on those types of things if it's not a seed iron condor for a negative credit. And that's what we've done the last couple of days. Now, I know Allison was explaining to you in the room what we're doing, where we had opened a 5-point spread iron condor. We took profits on one side, we took profits on the call side, widening the spread, and we closed the put spread. And then we yesterday opened a new iron condor, and today we took profits and ended up with a 10-point spread on the put side that matched against the 10-point spread on the call side from the first iron condor, and then we closed out of the 5-point spread calls, which was the second which was the call spread from the second iron condor. So what we essentially did was we threw some capital in. We've taken profits now on two different positions, and the way we structured those, and this was by design, we ended up with one single position. So we essentially ended up with all of our capital back. We're back to one single iron condor. It's a 10-point spread iron condor, and we have a positive credit on that, and we have about 120-point sweet spot. So just kind of wanted to share that with you. All of that was by design, just in terms of leveraging the profits out of the iron condors. Iron condors are a low risk opportunity. I think low risk because it doesn't require a significant amount of capital to put in. You know you're going to win on one side, and the other side has a forgiveness factor, which most of you have learned through the training that we provide at Options Moneymaker. So we leveraged profits out of them. We turned ourselves right back into having most of our capital back, and we still have opportunity for time value to decay. We may take a look at opening a new iron condor towards the end of the market today. My personal bias is I like to open these in the last 15 to 30 minutes of the market day, because since my intention is to leverage profits out of one of those four legs, one or two of those four legs of the iron condor, I don't want to open it midday and then have a big market move, and everyone may not want to day trade. So that would restrict you. You've got a big market move, you can't harvest the profits, and the next day, by harvesting the profits, you may end up with a net negative credit, which is what we're trying to avoid. So I try to open them in the last 15 to 30 minutes of the market. And if I can do that, then it just limits the amount of time that the market might move. Now, granted, there might be a big move at the open of the next day. And if that's the case, then that may be an iron condor that I don't end up adjusting and taking profits out of by widening the spread. It may just be an iron condor that I hold, continue to hold, or where I close one side of the iron condor to take a profit and then wait for a reverse cycle to close the other side. So again, the 15 to 30 minutes before market close is pretty easy to execute an order that way, and then want to be present when the market opens the next morning to see if we can harvest a profit. It was a little tricky this morning to take the profit on the NDX position. SPX was a little more stable. NDX was moving around quite a bit, and it actually was a little tricky. By the time I executed the order, I evaluated it quite a bit, I executed it, and I ended up with less of a profit than I had originally desired. But the bottom line was I ended up with all of my capital back because the put spread that we widened today into a 10-point spread matched up with the call spread that we had widened the previous day. So we're right back into an iron condor. All right, so let's talk about the charts. So I've talked a lot in the last few weeks about the rising pattern, the rising cycle, and how every rising cycle is followed by a declining cycle. You just don't know when it's going to start, but you can sniff around and look for clues based on some other technical indications that the chart will offer us. So the first one, and most obvious to me, was this longer term channel that we've been tracking on NDX. So if I look at a 2-year pattern here, this just takes us back to when we previously had identified a natural level of resistance in the market, which was back in early November of 2015 when NDX traded to a high of 47.37. So you fast forward out to the 16th of August and we traded up to 48.14.96. So if you have a level of resistance identified here as well as in August of this year, 2016, you can see that it creates a line of resistance that the market has naturally defined. This is not us trying to just arbitrarily put lines on a chart and try to force ourselves into thinking that we've hit an area of resistance. No, this is a natural level of resistance that is defined by the market. And then we have the corresponding support down here. I'm not as concerned about support right now because we're not trading anywhere close to that level of support. I need to do a little fine tuning on this channel and drop support down just a little bit to capture this natural level of support. And it's going to come very close to corresponding with the low that occurred on August 24th after that huge, unprecedented market sell-off back in August of 2015. But let's go back to our shorter time periods, 1 year, so we can see a little more clearly. It appears that on the 15th of August, we hit that sideways line of resistance as well as a rising cycle line of resistance. We fell away and bounced back higher, and it looked like we were trying to take out that high from the 15th again. And we were trying to do that on the 23rd. That did not happen. We came up just shy by pennies, and since then we've started to see a declining cycle. Now yesterday I talked about that declining cycle and I showed you a 10-day, 10-minute chart, and I believe at that time we had hit this high, we had come down and hit a low, and we were trading somewhere around in this range at the time. And I said yesterday that we could move up to resistance, which could take us up to the 48.05 range. And from at that point, it would be interesting to then see whether the market wanted to press above that resistance or validate this declining line of resistance. And what ended up happening, because we can now see it very clearly, is we moved almost right up to where I said. I wasn't predicting that, folks. I was just saying based on the pattern that we saw, that's where it could move to. And that would be a key price level that would determine whether we were going to validate the current declining cycle or whether we were going to break above. And in fact, we validated it. We moved up to 48.04.41, 48.04.41. And that ended up being a price point that the market determined was a natural level of resistance. And that price point has a direct correspondence to the prior natural level of resistance, which was on the 26th at about 10:10 in the morning. And also the beginning of this cycle, which was on the 23rd. Which was at about 9:50 in the morning. So you can see here that we have a high, we have a market high, we had another market high, and each of those market highs are clearly defined by the market, not by us, because all of the price activity leading up to it were lower highs, and all of the price activity leading away from it were lower highs. So the market has naturally defined where a top is. And in this particular case, by us putting a line on our chart, we can very clearly see that the market is defining tops that appear at this point in time to be lower highs. So that means that we have a declining pattern. The corresponding level of support is identified by the natural level of support here on the 25th, and then again on the 26th, and then again later in the day on the 26th. So we've got three levels of natural support defined by the market, and we have three levels of natural resistance. To me, by my definition, that's validation of a cycle. This cycle has integrity. Now, the index could at any time move higher and break above, or it could move lower and break below. But as of right now, with three tops and three bottoms identified, we have a pretty solid pattern in play. And when we back up and look at the 60-day, 60-minute view, we can clearly see where our rising patterns were taking us, where we stalled out and we moved sideways, and where we then transitioned into what now appears to be a mostly declining pattern. So let's take a look at this sideways pattern. So, I mean, this is actually a classic pattern here. It's not easy to see as it's developing, but that's one of the reasons I do like to refer back to my bar charts, is because when I put these channels on my chart, they stay there until I delete them or modify them. So now we have the hindsight benefit of being able to look back and say, we know where the rising cycle started, we know where the rising cycle stopped, because then we transitioned into a sideways cycle, and we know where the current declining cycle has started. And I, again, believe that this is a valid declining cycle, not just because we have three tops and three bottoms, but we also have lows that have now drifted below the lowest low of the sideways cycle. So you can see where we moved higher, you can see where we flattened out, and you can see now where we're moving lower, and we're moving down in this cycle. So where could we go? Let's just go out to the 31st, which would be tomorrow. We could see NDX trade down to 47.34. We could see NDX trade up to 47.88, or anywhere in between. So what I'm going to do is to continue to monitor this pattern. And typically intraday, I monitor on a 10-day, 10-minute chart just to see whether or not there's any Bollinger Band snaps that would be worth trading intraday, whether there are any indications that would tell me I might want to take action on an existing position that I hold. But right now, we appear to be in this declining cycle. The one thing that I'm going to be alert to here is you typically, for validation, want your cycles to correspond pretty closely to the Bollinger Bands. So prior to right now, this declining cycle has a reasonable proximity to the placement of the 2 and 3 standard deviation Bollinger Bands. I don't mean you have to be right at the 3 standard. I'm just saying, look at where this resistance and the support are picking up the price activity relative to the flaring out of the Bollinger Bands. It's pretty consistent here. But the one thing I notice is right now we have our resistance placed just below the 2 and 3 standard deviation Bollinger Bands and support just above. So this again is a 10-day, 10-minute intraday chart, which means that the Bollinger Bands may just continue to move, and we will find alignment between the Bollinger Bands and our channel. But that's the one thing I'm looking at and going to continue to monitor to make sure that we have some reasonable integrity of this pattern. So it looks to me, my interpretation on NDX, it looks to me like we are in the early stages of maybe the beginning of a declining cycle. One last thing that I like to do is I take a look at prior cycles and I look at the range of movement. What's the depth of the cycle? So when we began this rising cycle, the depth was about 127 points. Then we got into a more narrow range of about 93 points. The sideways pattern was about 60 points, and our current declining pattern is about 57 points. So although that is a range from the widest pattern of about 126 points to the more narrow pattern of 57 points, that 57 points is just beginning. It's just the beginning of a declining cycle if it were to continue. What I would be looking for is a widening of that cycle, because NDX does have a tendency to perform in reasonably similar patterns. Here's 77 points, here's 73 points, here's a more narrow 58 points. So we're not at all out of line with prior cycles that we've seen develop. So that's another thing that I will continue to take a look at. I do want to jump back to the daily before we leave NDX, and I want to just take a quick look at the studies here. And we can see that the AO is still showing weakening momentum. There was actually a pretty strong jump off today. It's all been red, indicating weakening momentum since the 12th of August. So that is yet another indication that we could continue to find ourselves in a declining pattern here. Let's take a look at SPX. SPX AO has been declining actually since the 21st of July. Let's take the studies off here so we can see the price activity a little more clearly. Let me get down to the 10-day, 10-minute here. Yesterday, this is the declining cycle that we identified. One top, second top. We came up close to that resistance yesterday and turned and headed lower. And we've got one level of support. On a 30-minute time period, I also added a channel today to track. This cycle that we talked about yesterday, I think is valid, and we had validation of resistance yesterday. So that's in place. That has not been modified. But I did add another cycle because what I noticed is that after we had this somewhat sideways trending pattern and we drifted below that sideways pattern, we had this low and then we had this rising cycle. And we had a low, a second low, and a third low, and they were consecutive lower lows, and then that marries up to one level of resistance. Now, I'm not sure yet that that is a valid pattern, but when I have three price points that the market has either defined as being resistance or support, it gets my attention. And in this case, it looks like we have declining support. And then because we want resistance to be parallel, we are attaching it to this level of resistance right here. So where could SPX go? Well, if it stays in this declining cycle, we could see it move down to support around 2156, 2157 range. If it stays in this longer term channel, it could move back up to around the 2186 range. But it gives us a range to work with. And when you can identify a range like that, an iron condor can be a great strategy to take advantage of that movement, short-term iron condor. I'm not talking about iron condors as management that we refer to as seed iron condors. I'm talking about just an iron condor that you can either open and wait for a profit on the whole thing, or you open and take a profit on one side or the other and then wait for the other side to give you a profit. or you open and harvest profits the next day by widening the spread and still maintain a positive credit. When you use that option of harvesting profits and widening the spread, what you're doing is actually pulling a bonus profit into your account, because then you're left with an iron condor with a healthy credit, and you're just waiting then for time value decay to benefit you. So SPX looks to me like it is very much very similar to NDX, where it's starting to roll over a bit. Now, the interesting thing is SPX has not, in this declining cycle that we've identified, has not traded below the low of the sideways time period after we saw the rising pattern. So the low of that sideways pattern was around 2147. The lowest low that we've seen so far is 2160. So it would not surprise me to see us trade down to that level. And if we broke below 2147, 2147 is a fractal bar, and if we do break below 2147, it would be an indication that we would most likely continue to see us trade lower. Now, one of the things that will catch a trader off guard is you see a price movement that breaks through a technical pattern. And in this case, this fractal bar, where this is the lowest low in a 5-bar sequence, we break below that fractal, and mentally we've now shifted into thinking that all activity is going to be to the downside. Never, ever, ever forget that no matter which way we are trending, the index is going to cycle. So just when you might break through a fractal, or you break below a moving average that is a strong indication perhaps of a continuation of the downside, then you start to see some movement higher, and you start to get frustrated and confused because you believe that you misread the chart. Well, more than likely you didn't misread the chart at all. It's just that the index is going to cycle higher within a declining pattern, just like it cycled lower a few times within a rising pattern. So don't ever lose sight of that. Let's take a look at RUT. Not too dissimilar to the other two patterns. We talked yesterday about how RUT came up to its natural level of resistance on the 23rd, was not able to take that out as it tried to a couple more times, and now we find ourselves in a slightly declining cycle. It is still early in the formation of these declining cycles. So I'm looking for points of validation, similar to what we saw yesterday on all three indexes, up and around this range. And actually on RUT, we got another validation today because we moved up to the area of resistance, and then we drifted lower. Now, on these three indexes, could we move higher above this short-term cycle resistance? We absolutely could, but as each pattern develops, as each day develops, we will continue to measure whether we are validating the pattern we've interpreted, or whether we are breaking above or breaking below that pattern. And that, to me, is part of the work that I think is essential for you to do as a trader and have a big picture view of your charts. All right, Allison, can we switch back to you, and let's take a look at the AbleTrend charts.
Sure. Should be able to see my 3-minute, 9-minute, 5-minute, 15.
All right. Do you have a 30, 90, or a 120 daily?
Yes, let me pull that up right now.
So after we go through the evaluation of the bar charts, much like we've done several other days, then I like to take a look at the longer time periods on AbleTrend. Folks, AbleTrend is the place that you want to take your trade signals from. Able trend is where you want to focus your attention after you have done a summary that provides you a macro view of what the indexes are doing. Then you want to focus on able trend and use those charts for your trade signals. So you have up the 120 daily, and I'm just gonna kind of go across the bottom here. NDX on the left, SPX in the middle, and RUT on the right. And it looks to me like we have daily support that printed again on all three charts. Just looking at that, it looks to me like we have daily support, but on NDX, we've been trading just below daily support today. So we may be trying to break below that, but Allison, highlight the red bar to the left of today's bar. To the left, the last red bar. Okay, go to the left. Put your cursor to the left. Move. Okay. Well, I can't see it quite clearly on your chart, but the last time we dipped below daily support, we formed a red bar, and that may have been an indication that we're breaking below support, but it did not actually occur. Instead, we moved higher. The next bar was a green bar, and we moved back above that daily support. So
It is a bit bigger, Mark, if you want to highlight it.
okay, so it's important that before you assume that in fact we are moving lower or moving higher, that you want some sort of validation. The fact that we've printed daily support here would tell me that we don't have confirmation of any kind of a signal here. We're actually trading between support and resistance, and we've broken below this level of support. It looks to me 1, 2, 3, 4, 5 times, including today, and yet we've reversed and moved higher. So I think we are starting to see the beginnings of a pattern that may take us lower, but it still is premature. And I'm seeing the same thing on SPX. We printed daily support today. You can see where we dipped significantly below support previously in the formation of those two red bars, but no confirmation, and in fact we moved back up above resistance. So we're bouncing back and forth between support and resistance. Technically on the 120 daily on SPX, we're double stacked to the upside. So we're just going to have to see how that plays out. But go to the chart above SPX right there. What time period is that, Allison?
That is the 30, 90-minute charts up top
So
and the 120 daily on the bottom.
The 3090 is showing some weakness. And as Michael emphasizes, it's always the shorter time periods that are going to start to see the bricks crumble first. And you can see that we are no longer printing support, but we're printing 90-minute resistance on SPX. And all the bars have been green. When was the last time we actually had anything but a green bar? That was the blue bars up top there. So we've been printing green bars, neutral bars, and you can see how tight support and resistance we're printing. Good news is support's not printing anymore. It's kind of given way to resistance. These are all clues, folks, that we may be in the beginnings of forming a new declining cycle, starting with the macro view on the bar charts all the way through these longer time periods on able trend. So now, Allison, let's jump to your 515 and 3-9 charts on the indexes. All right, well, maybe Allison can't hear me. Um, Allison, can you see the 515 and 39?
Yes, Mark, I can. My sound's cutting in and out a little bit. There you go.
Okay, so on the 515 and the 39 on NDX, you can see we're double stacked to the downside of both time periods. So those are good signals. In fact, right there, you're trading in the sweet spot of the 515. If you wanted to take a declining bias trade, that could potentially be a good, valid trade. You would want to wait for the bar to turn red, and you would ideally, if you want to take the most conservative trade, you want to wait for that bar to close red and then take a trade to the downside. You can buy a put, buy a long put. I personally would be buying to open a put in the money because it looks to me like we're starting to shift lower. So I would buy a put in the money, and that way, if the index moved higher, I would be able to cover my trade by selling to open a lower strike put and create a long put vertical spread that both strikes would be in the money. So I'd try to go, I haven't looked at the chain here, but I'd try to go maybe 50 points in the money so that if I had to cover it, I still have a potentially profitable trade that's well placed in the money. The other way you could trade that is if you don't want to put up the capital for a long put, is you could just open an in the money put debit spread, a put vertical spread. And typically, if you're going to have a 5-point difference between the strikes, you want to have a cost basis of maybe $3 to $3.20. That typically would indicate that you're in the money far enough. That creates a forgiveness factor. Yet it gives you a good profit opportunity. If you have $3.20 of cost basis, then you have $5 of maximum potential value of the spread, which means there's $1.80 of potential profit on that trade. So $1.80 of maximum potential profit versus $3.20 of cost basis is a reasonable risk to reward ratio, in my opinion. Then SPX is not consistent at all with NDX. It looks like it's breaking above 5-minute resistance, moving back up towards 15-minute resistance. And the 3.9 is moving the same way, and we've started to see support printing on both of those. And then RUT is the same thing. We're now double stacked to the upside on the 3.9, and you can see that we're moving higher on the 5.15. So my personal summary of all that, starting with the macro view and the bar charts all the way through the Able Trend charts, is there is weakening. There are weakening patterns that are forming. They're not completely confirmed yet. Stay tuned. Watch for the signals, much like on NDX, trading right at the sweet spot on the 515 as a potential downward bias trade. But be alert to what type of strategy you want to trade in order to take advantage of that. We're going to continue to look for some iron condors in this market, short term, 2 to 3 weeks to expiration, looking for opportunity to open towards the end of the market day. Not guaranteed we're going to do one every day, but look for them towards the end of the market day in the last 15 to 30 minutes, and then take advantage of opportunities to harvest profits on those the following day and still end up with a positive credit on the iron condor. So that's my view of things today, folks. Appreciate you being part of our community of traders here in the live trading room at Options Moneymaker. And stay tuned. Allison's going to continue to monitor the trade signals here, and we'll highlight for you Whether we're taking a trade or not, she's going to highlight for you any opportunities to take either a aggressive trade and explain why it's aggressive. Like if you got into NDX downward bias based on the 515 right now, that would be an aggressive trade because there's no red bar confirming that signal. If you want to take a conservative trade, she's going to point that out to you, and just let us know if you have questions. All right. Thanks for being here, everyone.